Our speakers, along with Ms. Soni Kumari on the stage, will be Ms. Joni Teves, is the commodity strategist for UBS, and Mr. Achal Abhishek is the AGM for SBI's Bullion branch. Telling you a little bit more in detail about all the three people that are making a presence here on the stage. Ms. Soni Kumari is the commodity strategist at AHZ Research with extensive experience in commodity markets. She specializes in both macro and micro analysis across sectors including metals, agriculture, oil and gas, and renewables. A certified chartered alternative investment analyst, CAIA. She excels in data-intensive analysis, price forecasting, and report writing. Her expertise spans across metals, base metals, energy, renewables, bulks, and agricultural commodities, supported by a strong foundation in econometrics, modeling, and quantitative analysis. As Ms. Soni Kumari walks up on the stage, our next panelist will be Ms. Joni Teves. She's the commodity strategist for UBS and a seasoned professional currently serving as strategist at UBS Securities with a robust background in financial industry. She previously held the position of analyst at UBS Limited's broker arm from 2011 to 2019. Her expertise also extends to her role as a strategist at UBS AG's London branch, where she contributed significantly to firm strategic initiatives. Her deep experience and strategic acumen continue to make a strong impact in her current role at UBS Securities. And our final speaker for this panel is Mr. Achal Abhishek, the AGM and branch head of Bullion branch at State Bank of India, Mumbai. With over 25 years of banking experience, he excels in treasury operations, HR, and managing large branches. An avid reader, he has a keen interest in technical analysis, financial astrology, and health topics like NLP, homeopathy, and acupressure. Known for his precise analysis focused on support and resistance levels, he is passionate about learning and teaching these analytical techniques. Well, we do hope that Mr. Achal Abhishek is able to make some serious astrological predictions also about the forecast on gold pricing. Ladies and gentlemen, with this, I leave this session in the hands of Ms. Soni Kumari.
Thank you for this nice introduction, and good evening, everyone. Very pleased to be here, and I thank Eventel for giving me this opportunity. A little secret here, this is for the first time I'm chairing a session. So to get the ball rolling and to set a context around the discussion, an interesting thing that we have heard about gold right through the advent of money as transaction medium is how gold was the currency of kings. But looking at its price rally over the last few years, a different version of the quote comes to mind, which is, gold is the king of currency. Or in other words, we can say it's an ultimate currency. This holds true when debts in developed markets are ballooning, countries are losing interest in USD-denominated assets, and alternative financial payment systems are in the making. So gold's debt-free nature appeals more than ever. Any trade settled in gold is final, as there are no further liabilities nor any looming counterparty risk. Gold is highly liquid asset that can be used as alternative medium of transaction in case of financial sanctions. It also helps to maintain anonymity, as unlike currencies, it is difficult to track the origin once it is melted. So it's right to say that gold remains an antidote to debt and other geopolitical uncertainties. And in the last few years, so much has happened, but gold has managed to maintain its shine. After the COVID pandemic, the world was hit by intensifying geopolitical tension, with Russia invading Ukraine, leading to a slew of sanctions on Russia by the Western world and further freezing of Russian assets. On the other hand, on macro front, in the wake of the 2022 inflationary shock, The US Federal Reserve deployed its most aggressive monetary tightening. Normally, higher rates, as we know, higher rates are detrimental for gold prices. But this time it was different, with central bank purchases uh, being the most influential development as it offset some of the investment demand losses due to higher interest rates. So gold not only survived, but thrived as one of the top performing asset classes and has been making multiple highs since 2023. Now, the world is looking at a slightly different economic setting. A very anticipated rate cutting cycle is around the corner. It is appropriate to think that what will happen to gold here on and what could be the drivers when prices are already at record high. So to discuss the macro outlook and gold price drivers, we have Joni Teves from UBS, and to take us on interesting ride on technical and astrological analysis, we have Achal Abhishek from State Bank of India. So please join me to welcome Joni to present the gold price outlook through a fundamental lens.
So good afternoon, everyone, and thank you for the opportunity to share the UBS outlook on gold. I am honored to be here today to share our views on where we think gold prices are going and what takes us there. So I guess to answer the title for this session, where do we think gold prices will go? The short answer is we are bullish on gold. We think prices will continue to rally over the next 2 years and continue to make higher highs and higher lows. So what are the factors that are contributing to this view? Firstly, we think that fundamental demand is an important factor that underpins this rally in gold. And starting off the discussion on fundamental demand, we focus on the official sector. So this has been a very strong supportive factor for the market over the last couple of years. But actually, central banks and other official institutions have been net buyers of gold since 2010. What has been different in the last couple of years is that the volume of purchases have stepped up. So previously, it was accounting for about 15%, 10 to 15% of annual mine supply. But in the last couple of years, that has accounted for about 30% of global mine supply. So the top five purchasers of gold within the sector has been China, Russia, India, Turkey, and Poland. And a key driver for these purchases has really been the desire to diversify reserve assets among the sector, particularly in this environment where there is heightened geopolitical risks. Our expectation is that this trend is likely to continue as these factors that have driven central banks and official institutions to add to their gold holdings are likely to continue. There has been a lot of news recently about China slowing down purchases. They haven't been adding to their gold reserves in the last 3 months. We don't think this necessarily indicates signals a change in the overall strategy. We do expect the sector as a whole, and not just China, to remain net buyers, maybe at a slower pace of purchases than we've seen in the last couple of years, but certainly still elevated relative to historical levels. We think that this does the buying from the sector does present two-way price risk for the gold market, in the sense that if we are overestimating the amount of purchases from the sector, then it could mean that the support that the market is getting is a lot lower than what we are anticipating. On the flip side, if there is scope for even more purchases from central banks, sovereign wealth funds, and these types of institutions, it could mean another level shift higher in gold's trading range. The second part of fundamental demand that we think will be important is physical demand, so particularly in key markets like India and China. And our expectation there is that in spite of higher gold prices, we think consumer demand will ultimately be resilient to this rise in price. We've seen over time that consumers tend to adjust to higher price levels. And although we've seen a pullback in India in recent months, similarly in China as well, with the onshore price falling into a discount relative to international prices, we think that towards the end of this year, we should see that seasonal pickup that we usually see. So starting with India, in the lead up to key wedding season and key festivals, we think we will see that pickup in physical demand. And then towards the end of the year, we expect demand from China to pick up ahead of the Lunar New Year holidays at the beginning of next year. Then the second part of the story in our bullish gold outlook is really the drivers from the macro side. So in our view, we think that US real rates, the US dollar, and some measure of uncertainty are key factors that drive the price of gold. Interestingly, this year, this has been challenged, particularly in terms of gold's relationship with US real rates and the US dollar. So it has been particularly difficult to explain gold's rally, especially at the beginning of the year. If we put together a very simple gold model using these three factors that I mentioned, gold has been trading at a very large premium relative to that quote-unquote fair value. However, I think it is important to note that firstly, there is an asymmetry to gold's relationship, particularly with real rates. We think that over time, based on our analysis, gold, this asymmetric relationship means that when real rates fall, gold actually rises by a much larger percentage compared to the extent that gold falls when real rates rise. And I think that is supportive for gold, especially given our expectation that real rates should fall from current levels. And also, particularly when real rates fall below a certain threshold, that asymmetry actually becomes even more pronounced. So again, the expectation that real rates fall from these levels as the Fed cuts policy rates should be supportive for higher gold prices. And we do expect that the Fed will start cutting rates in September. Our house view is that we will see 3 25 basis point rate cuts this year. And we have seen in the past that Fed policy easing tends to be supportive for gold. And especially in more recent easing cycles, the gains have been much stronger. The third and final piece of the puzzle is investor flows and positioning, which we think is ultimately what drives the gold market higher. So even though gold has been very popular this year, we've made new highs quarter after quarter, we don't think that positioning in the gold market is actually overly crowded. We think that there is scope for investor positions in gold to continue rising. The reason why we think investors will continue to add to gold positions is that there is a lot of macro uncertainty right now. There's a lot of geopolitical risks. And with the expectation that the cost of having that position in gold is going to fall, it incentivizes investors to start really building those allocations towards gold. So I would like to round up my discussion with sort of highlighting the key risks to our bullish gold view. So the key downside risk at this point would really be if we see a shift in Fed policy expectations, especially if we get a string of stronger US data that basically shifts to a more hawkish policy expectation. I think that creates a more bearish environment for gold. But at this point, I think the bar for that is quite high, given how US data has started to play out. So I think the more immediate risk is probably just a bit of retracement from the current rate cut expectations, or a bit of retracement in the weakness in the dollar that we've seen recently. The upside risk to our view is if we get even softer US data prints and further kind of dovish expectations from the Fed. Also, if we get a pickup in geopolitical risks, I think that could present upside risk to the gold price, although those tend to be a lot more volatile in terms of driving the gold price. I think any expectations on the Fed and US real rates tend to have a more long-lasting impact on the gold price trend. And then finally, in terms of two-way price risk, as mentioned earlier, I think buying from the official sector does present two-way price risk for gold. And also, I guess, the extent to which we can see investor flows come in. So if we are overestimating the amount of investor flows that could come in, if we actually are underestimating the extent of positioning, then it could mean that it's more difficult to get to the sort of price targets that we are thinking of. Conversely, if there's a lot more room for investors to build gold positions, and we do think that there's scope within wealth managed community, for instance, we think we are still in the early days of private banks outright recommending gold allocations. So I think that could trigger the next wave of buying within the gold market. I'll stop here and pass back to Soni to continue the rest of the discussion. Thank you.
Thank you, Joni. That was very comprehensive. Now I request Mr. Achal Abhishek to present his technical and astrological method of forecasting gold price. Achal, over to you.
I'll start with the disclaimer. The views expressed in this presentation are personal and not related to bank, and this is for educational purpose only. And the bank is in no way connected with it directly or indirectly. To start with, I would like to just start with one question, and the question reads as under: which type of trader is a winner in the market most of the times? It is alert trader, lazy trader, active trader, passive trader, trader like leopard, and trader like crocodile. Yeah, but there is one suspense. I'll take the answer at the last of the presentation, and I have also some gifts with me. First, I would like to define technical analysis. I would like to just recite one line of my Guruji, which is as under: technical analysis is as easy as making a cup of coffee unless our eyes and brains are trained, and the trade should be process oriented and not profit oriented. What does it mean? It means that we have to abide by the stock market sanskara. What is the stock market sanskara? Means the stop loss. Our stop loss is the best friend. First, we get the stop loss, then we get the target, and then we get the trade. Now, the definition part. It's a method of evaluating based on the previous price, movement, and volume, and we get the new price. This includes candle. Every candle has its own psychology coupled with volume. I have mentioned here 3 W's of candlestick pattern. These are as under: who own, how own, and where on. Means there are various type of candlestick pattern. I'm not going to describe that. The time doesn't permit me. But I'll discuss where. And the video, it's a video. I have compared it with the game of cricket. In cricket, placement is there. It's a video of Virat Kohli playing a cover drive. The same cover drive gets a boundary, and sometimes there are no runs. Why? Due to the placement of the candle, placement of the stock. The same happens with the candle. Means candle, if not placed well is going to just hit our stop loss. And a candle, if is placed well, is going to give our target. There is, it's mentioned VRS system. VRS is not the voluntary retirement scheme. It's basically volume coupled with RSI and stochastic. Since this is a technical class, that's why this a bit technical terms. And this Amrit line. Amrit means that not dead. Means market is going to honor this line. How this line is drawn? This line is drawn based on the candle, placement of candle, as well as the confluence of volume coupled with RSI and stochastic. And rest other are, trend is our best friend, we all know. This buy always on support and all these things. Last but not the least, we have to plan our trade and trade your plan. It has to be documented. It has to be backtested. There are so many dead bodies in the stock market from different stocks, and we just go and backtest that. Now, this forecast of medium-term gold price. This I have taken the weekly chart, and this pattern is making this rounding bottom formation, and I have just the depth of the rounding bottom formation is the target, and the target is around 2800. This is the midterm target, around 2-3 months, 6 months. It would be like that. And next long term for 1 year, 2 year, and the same cup and handle formation. This is the cup, and this is handle, and the target, long term target I have taken is 3200, and the SL below the trend line AB. This is all about technical, because I have to present here astrological analysis also. Let us deep dive into astrological analysis. This is astrological analysis, gold. The line reads, millionaires don't need astrologers, but billionaires do. We'll see the power of astrology in a few slides. This is I'll just stick to one method, that is aspect method. Aspect method means angular distance. Angular distance between two planets. There are 12 planets in the universe, and each planet is making aspect from one another, and important aspects such as 0 degree, 180 degree, 90 degree are some of the aspects. And just we'll see how it is effective. We can also decipher swing through astrology. This is Mars, one of the planets, and Jupiter. It is 0 degree. It's a powerful aspect, and just see, after making the bottom, it has not less than 200 to 50 USD, it has just increased. Now, this is the date, 19th April, and you see, here the aspect 21st April, and this is 90 degree. This is the symbol of 90 degree, and see, after the formation of this aspect, the market goes like anything. Next one, this is the 23rd July 2024 budget day, and at this 11:07 market, at that time budget was being presented, and this just see the fall of not less than 4,000 to 5,000 rupees. I have also compared Fed rates and aspects of planets with respect to movement of gold price. These are the Fed rates I have mentioned here, and these are some of the aspects I have mentioned here. See how beautifully it is moving. And at the same time, the direction of the market is also predicted through astrology. Next is Fed rates 2023, and the movement is also given. Next, aspect of Sun with node. When the Sun aspects with node, Rahu and Ketu, see the result. How beautifully the market is just taking upward or downward. And I have mentioned also next few dates in coming months where reversal or extreme volatility in gold price is going to take place. These are for, I think, for September to November, and timing is also given as per Indian time, and I think there should be some reversals. Now I come to my first slide, and which type of trader is winner in the market, rather which type of trader are you? So I'd like to just get some answers from you. Which type of trader is winner in market most of the times? Okay, as per me, a lazy trader wins market most of the times because he waits for the market, he waits for the time to come, and then he takes the trade. Similarly, the passive trader, he is going to win the market, not active trader, not taking trade at all the times. But unless the level comes, then the trade has to. And trader like crocodile means he wait for the trade. The crux is waiting for the trade is very important. And that's all from me. Thank you, Eventel, for calling me. Thank you.
Thank you, Achal. That was very interesting. So for Q&A, we are left with 3 minutes. Hope we can get five minutes grace time. Yeah. So, Joni, I'll start with you. Indeed, gold prices has been making higher highs and higher lows, and lows have been very, very shallow, I must say that. And so some of the questions coming to my mind, and the recent development, what we have seen in last 2 weeks, that market has suddenly started pricing 100 basis points of rate cut by the Fed. Whereas some of the economists are still forecasting a 50 basis points rate cut. So in case if we get a shallow rate cutting cycle in this cycle, so will this change the trajectory for gold prices in your view?
So I don't think it necessarily changes the overall sort of medium to long-term trend in gold, but it could mean some consolidation in the near term, just as a function of how far market pricing of the Fed has gone, and even to the extent that how weak the dollar has become in recent weeks. So I think, if there's a scaling back of those expectations and the move in the dollar, if we get some strong data out of the US, that could result in some consolidation in gold in the near term. But I don't think it changes the overall picture, because if it is still a case that the Fed is in a cutting cycle, I think that still creates a positive backdrop for gold. The opportunity cost of having that position in gold is going to decline, and I think that should incentivize investors to build allocations in this type of macro environment.
Yes, thanks for the answer. I think if there is any hawkish tone from the Fed, this will create a short-term volatility, but the long-term bull cycle is still intact for gold. Coming to the next question, which we have largely discussed in our previous session around central bank purchases. So I'm just talking about reported purchases, not unreported purchases, which World Gold Council reports in its quarterly demand trend report. So central bank purchases have moderated in the last few months, and the concern, market concern, I would say, was around China. China paused its gold buying for the third consecutive month. So is this telling us something like higher prices impacting their decision? Because this has been, the central bank purchases has been sensitive to gold prices as well.
So I'd say the official sector, not just China or central banks specifically, but I think the official sector as a whole, the way they tend to buy gold is really more, they tend to leave offers and want to wait for the market to come to them. So they don't tend to like chasing the market higher when the market is rallying sharply. So I think it is understandable that we've seen sort of a slowdown in purchases as gold has continued to make new highs. But I don't think it necessarily changes the motivation to build gold reserves. I think all the factors, particularly diversification, that have driven central banks to start adding to gold reserves is still intact. So that's why our expectation is that they will remain net buyers of gold going forward.
Right, and I think China still has a lot to buy because it's the share of its gold reserve to its total reserves is still low, nearly 4%, if I'm correct. Yeah, so it's still there is room for China to accumulate gold in its vault. Coming to physical gold demand, which has been surprisingly resilient for last 2 years in the face of higher prices. And this year, what we had seen that first quarter, Chinese gold imports were at record high, but in last few months, they started moderating. So in your view, what's going to dominate, whether higher gold prices is going to dampen its gold demand, or the kind of economic situation China is in, uh, because their property market is still in trouble, equity market is not performing well, and at the same time, household saving in China is still higher. So people are not left with many alternative options to invest. So which is going to drive the gold demand in China?
I think in China, there will be offsetting factors, as you mentioned. I think the higher prices will act as a headwind for jewelry consumption. But on the investment side, we think that demand there will remain strong because gold is acting as an alternative asset for onshore investors. So I think that will remain in place. And more broadly, actually, not just China, I think we will see sort of a similar dynamic in other physical markets as well. I think in India, the fact that the government has cut import duties and our kind of positive outlook on the Indian economy, I think will act as an offsetting factor to higher gold prices. So that's why we expect physical demand more broadly to be quite resilient to higher gold prices.
Yeah, I think these two key markets, China and India, they have different factors supporting fiscal demand for gold. Coming to my last question, because time is already up, I think it was there in your slide, with gold prices has been trading well above its fair value. Do you think gold is in a bubble? I started getting this question recently, so that's where this question is coming from. So do you think it's in bubble, and what could be the downside risk with investors' positions that is still light?
So just looking, as you mentioned, investor positioning is light. So I don't think it necessarily means that the gold is in a bubble just because it's trading above its fair value. I think that gap is basically telling us that there are other factors that are driving gold at the moment, which is not surprising because gold is an asset where there are a lot of factors that can affect the price. And I think central banks, as we discussed, or official sector more generally, has been a key factor providing that support to the market. That is not being captured in the model. And also positioning, the fact that investor positioning is light has also meant that whatever gold positions are there are a lot more resilient because they are more for diversification purposes. So they have been a lot more resilient, and I think that is also something that is not being captured in the model. So in terms of the risk, I think it's really if the macro factors turn negative for gold, that's when I think the risk of investor flows turning negative for gold, where you probably see short selling coming in, which at the moment, I think it's a very tricky position to short sell gold in this type of environment where a lot of the factors are actually quite bullish.
Yeah, indeed, there are factors supporting gold prices. And if you compare the history, I think 70 and 80, it was like 20 times rise in gold prices. And we are not at there. It's just 1.5 times since 1650, around that level. So we are not in the bubble. Thank you, Joni. Achal, I'll come to you. I think the last slide was very interesting where you talk about the reversal. So what kind of reversal you're going to see, and what could be the intensity of the price reversal in gold prices? Personally, I would be interested to buy gold once, if it is a deeper price correction. Thanks.
See, the reversal of gold price may be obtained from astrological aspects also. But at the same time, the trend is predicted. And reversals not less than 150 to 200 USD, it should be that. But it depends on the aspects. If it is 0 degree or 180 degree, the reversals would be more. And if it is 45 degree, 90 degree, it should be a bit around 100 or so.
Okay, yeah, thank you. We do have some questions from the audience. So before we wrap up, Joni, if you like to take up these questions. The first question is about outlook on silver price and what would be the gold price ratio. And I think recently it has underperformed quite a lot.
So we are actually quite bullish on silver as a function of our bullish outlook on gold. So we think silver is in a position to really outperform gold, especially because in addition to its positive correlation with the gold price, we think that silver's fundamentals is actually very supportive. So we are expecting deficits in the silver market over the next few years, and I think that presents an additional kind of supportive factor for prices, and an additional factor that will encourage investors to become more active in silver. So we think there's more downside to the gold-silver ratio from these levels and potentially towards the long-term historical average, which I think is currently around 68.
Thank you.